Hello, and welcome to Real Estate Investing for the Win. This is a webinar series about real estate investing, and today is the first episode. It is Introduction for Real Estate Investing, wanting to ensure that we are all on the same page, that we have a common foundational language. And this series is really targeting new investors all the way through savvy investors, as we're going to delve into different niches of real estate as well. So welcome to our webinar series. This one is Introduction to Real Estate Investing. I am your host for today. My name is Linda Peterson, and we're going to cover basics of real estate investing. We will be bringing in experts from different fields to join us and share their experiences too. At the end of this webinar, we'll share some topics you can look forward to and are open to covering anything else, right? So today we will provide an overview of real estate investing, introducing key terms, exploring different types of real estate investments and how real estate generates income, as well as I think it's important to always understand ways to hedge your risk, because there is always risk associated to real estate investing, as with any types of investing, right? So what is real estate investing? Real estate investing is the purchase, management, and sale or rental of real estate for profit. Investors may own one or more properties or pool money with other investors into a fund that includes several properties. So is investing in real estate a good idea? Real estate has traditionally been considered to be a sound investment, and savvy investors can enjoy a passive income, excellent returns, tax advantages, diversification, the opportunity to build wealth. However, real estate investing can be risky, just like other types of investments. Would you consider yourself an active investor or a passive investor? An active real estate investor is someone who directly is involved in the process of finding, purchasing, and managing a property. This type of investing is more hands-on and requires a lot of analysis, research, and expertise. Active investors are responsible for a variety of tasks, which include analyzing deals, purchasing the property, updating the property, renting and dealing with tenants, ensuring that all of the housing, zoning, and other regulatory laws are followed. A passive real estate investor is someone who contributes capital to a real estate venture but doesn't actively manage or make decisions about the property. Instead, the investor relies on other parties to handle tasks like maintenance, repairs, tenant screening. This allows investors to earn an income from real estate without being the responsibilities of being a landlord. So I don't know what you like in your life, whether it's you want to go out there and you want to get to work and you want to see the fruits of your labor, or you'd rather be sitting on a beach drinking a Mai Tai and getting your investment having continuous growth, and even when you're sleeping. So I'm interested to see what kind of investor you want to be. And then the other piece is, are you interested in being lending as debt or investing for equity? And so kind of the difference between the two is that if you want to do a loan, right, with more of a fixed return for a fixed period of time, you can do a debt, right? And usually that has the property is the collateral, and you're usually in first or second position, and you've got a loan, promissory note, deed of trust, and you're additionally insured on that piece of property. Whereas investing for equity means that you get a piece of the business, right? And so it's the same as stocks, right? So if I'm investing in the stock market, I get a dividend or a return as they profit as well, right? My stocks can go up and down. I can get that as well. But I could also invest in real estate, for example, into a syndication or into a fund, or directly into a property, a specific property with somebody that I know, and I'm now getting a share of the business. So as that business profits, then I get a profit as well. And as the value of the property or the business increases, then my value in my investment also grows as with that, right? So debt investments do have a guaranteed rate of return, but there is still a level of risk. Whereas equity investments do have a higher risk, but they usually offer higher rewards as well. So the rewards aren't guaranteed, just like when you buy in the stock market, right? You're not guaranteed to get a return. Same with equity, but when you do profit, it's usually at a higher rate than you do from debt. So I wanted to also walk you through some examples of active investments and versus passive. So we had a property that we found some land, and we were able to, and we live in Austin, Texas. And so we found, and there's a lot of gentrification going on downtown where they're tearing down a house and building new. But sometimes the house that they're tearing down is in rental level conditions, right? And we found one that was on pier and beam, and we actually moved the house. And there's a whole process behind moving the house, but we moved the house, fix it up, and now keep it as a rental. So it was kind of a BRRRR method, right? Which is the BRRRR, BRRRR, right? So buy, rehab, rent, refi, repeat. But in this case, we bought the land, we bought the house, we moved the house, we fixed it up. So we rehabbed it, and then we rented it and refinanced it. And so that was a cool slant, especially in an area where it's more expensive. And so that was residential. An example of active is we built and launched our first RV park just outside of Austin on the northwest side. And that we actually bought. It was a teardown mobile home park. And so I think in just under 7 acres. And so I think before there was like 18 mobile homes. And in that same space, we were able to put 81 RV slots and cabins. And so working through the process of the different jurisdictions, the permitting, the development, and then the operations. So that's a lot of active work. Passive investments and examples is from a residential standpoint, we bought an existing Section 8 rental where the tenant was in place. They stayed in place. We didn't have to work on the property itself. And so we invested it at a certain price, and every month we got a rental income, right? That was cash flowing and could pay down a mortgage if you have a mortgage. And then when the market increased, we were able to sell it for a profit and keep that profit as well. And then passive, right? For example, in our RV park, we have passive investors who have invested in equity in that RV park. And as the property and as the value of the business grows, their investment grows. And as we get profits, they get a cut of the profit as well. Perfect. So types of investments. What types of investments are there? There's residential, such as single family homes, mobile homes, tiny homes, condos, a single house where people live in, right? And usually residential is considered 1 to 4 family residential. So if you've got a single family, a duplex, a triplex, a quadplex, those would still be considered residential. Commercial is a multifamily RV parks, mobile home park, office buildings, rental spaces, or warehouses. Industrial includes factories and distribution centers. Land is vacant land, agricultural, and you can even take land, subdivide it, and convert it into commercial, whether you've got retail in front, you've got subdivision, or a combination of those pieces on that land as well, or even farmland. So key terms and concepts, want to make sure that we are on the same page. The first one is appreciation. It's when your property increases in value over time. And an example is that you purchase the property for $200,000, later you sell it for $225,000. Your capital appreciation on that property was $25,000, and hopefully in between you got cash flow, tax depreciations. We're going to go through some of those in just a little bit. So cash flow is the net income from a property after expenses. So an example of this is that your operating cash flow is $40,000, but your expenses are $5 and $15, which is $20, which means your free cash flow is $20,000 on that property. Cap rate. Cap rate is the ratio of net operating income to property value. It's the ratio of net operating income to property value. So an example is if my property is worth $400,000 and I've got an 8% cap rate, that means my income level should be $32,000. So one way to look at it is say, how much income is that property producing based on the cap rate, right? So when somebody's selling a house and they say that the cap rate is 8%, right? That means that they're telling me the cash flow. But when I'm now going out and looking for a property and I'm creating projections for that, I don't have established income. So I would look at market cap rate. And usually when I am like downtown, like for example, downtown Austin has higher demand, so the cap rate is lower. And as I get further out, the cap rate goes up, right? And so I can use that cap rate to kind of denote the value of the property and project what's going to be the value. As I say, okay, here's going to be my projection of expenses. Here's going to be my projection of income. And then I say, what's the cap rate for that area? It can help me determine what's the future value. So you can use it in both directions. All right, and then ROI, return on investment, is the measure of profitability of an investment. And in this example, if you have a net value increase of 150,000 over renovation cost of 100, you've now increased it by 50%. So your ROI would be, I put in 100, I got out 150, so my ROI is 150%. So how does real estate generate income? How does real estate generate income? It's really around three categories. One is rental income, which is monthly payments from your tenant, and then that can create cash flow. And if you have a mortgage, they're paying down the principal and now the value of what. So say you buy it at 100,000 and over time they pay it down to 80. Now you've created 80,000 in additional equity in that property. Appreciation is you bought it for 100, over time it became 120, so now you've created a 20,000 in positive equity. And if you put those two together in that example, you bought it at 100, the tenant paid down the mortgage by 20, you go to sell it and the value is 120, you've now created 40,000 in additional profitability or equity into that property through that process. And tax benefits, deductions for mortgage interest, property deductions, and other expenses. So work with your accountant and your attorney to make sure that you're optimizing all of those. Benefits and risks of real estate investments. Obviously, some of the benefits are steady cash flow, consistent rental income. Who doesn't love that? Long-term appreciation, potential for property value to increase. And we usually see properties appreciate. I mean, just look at your own home. If you bought it, 10, 15 years ago, what was it then and what is it now? That's what you can look forward to in real estate as well. Diversification, adding real estate to an investment portfolio can help reduce your risk, especially if you've got higher risk investments in your portfolio. And then, of course, real estate, there's so many different kinds. Tax advantages, various deductions, and benefits as well. On the other side, with regard to risk, there's market volatility, right? We're seeing markets fluctuate, not only at a macro level, but also a micro level. And we're going to get into that in just a second, in understanding how to analyze it, what to look for. Property management challenges with tenants and maintenance, financing, obtaining, and managing loans as well. And then regulatory changes, zoning laws, tax changes, and other regulations. And this is where, as an active investor, you really have to stay honed in on it. And this is why, if you're a passive investor, you want to invest with somebody who's on top of that as well. So hedging your risks, right? There is always risk, but how can you reduce your risk? And there's things that you can do to hedge your risk. We were developing during COVID, and it's important to understand how can you hedge against something like COVID, something that's a pandemic that is so impacting. And the first time we went through it, we weren't quite sure. I will say that Austin was a incredibly hot sellers market, like insane hot sellers market. And we had, as a seller, when we were like super hot sellers market, it would mean that you would put out the list price higher than you thought. People would still offer way higher than you expected. Not only would they waive the option or contingency period, but they would even waive financing, meaning that whatever they contracted is what they would bring to the table, regardless of what it appraised for. COVID, for example, it was, there were many changes, right? When people stay home, and aren't traveling as much. Restaurants took a big hit during COVID because people weren't going out to be around other people and be social. And so you have to really think through that. And it's good to have an investment to hedge against COVID where it's good when good times are good and it's bad when times are bad. And that's personally why we like RV parks. So inflation, as an example, right? It's when from a real estate perspective, especially during development, it's when, like, as we were building the RV park, we saw a 30% inflation on materials. And, obviously, the faster you can develop something, the faster you're going to hedge against the market changing drastically. And the longer things take, when you've got things like COVID and inflation, it can really impact you. And that's why you have to have somebody who's at the helm, who's really on top of it, who has experience, and who knows how to navigate and persist through those pieces. And so when we were developing the RV park, we didn't have a lot of materials, right? And even though we did have hits on material and 30% inflation costs, right, we had contingencies built in. We were conservative on our numbers. And then we started researching for alternatives. Instead of maybe buying a park model cabin, developing one ourselves, right? So when we couldn't get some of the materials, such as the pedestals, we found other resources in other locations, and just got creative with it. One of the challenges we saw during COVID and during inflation that's still playing out is that a lot of multifamily projects are going under, and it's partially due to variable rates, right? So when a variable rate can seem really appealing, but you might need to evaluate, is the market going to change and potentially impact that? If you've got a fixed rate, what your numbers are. It may not be the best when you start, but at least over time you've got it secured. And some of these variable rates have really impacted some of these projects where, they were projecting certain returns on, based on their debt and their income, and their debt is going up because of the variable rate. And then as they were developing, like a multifamily has a high volume of material. And yes, you can have a bigger return on multifamily, but you can also have higher risk, right? So you really need to figure out where you are in that spectrum and what works for you. So, working with experienced developers and operators could bring, for example, one of our RV parks, our GC is an investor with us. And so when everybody has their best interest into that investment, then it's going to be a better example of success. So leveraging experienced developers and operators and feasibility studies and appraisals. So it's important to understand that when you have a developer or an operator, that you want them to be specialized in that niche, in that area, right? There's a higher probability, and then also their personality. Are they someone who's going to take risk or be more conservative, and then address it and attack it? Leveraging feasibility studies means that they are engaging potentially third party, and we typically do as well. We engage third party experts to go help us analyze what's the market like, what are our strengths and our weaknesses, what is our competitors, right? What is the supply and demand, macro and micro, in that specific area, in that location, for that specific type of project. And by doing that, not only are we also evaluating the market, but we're also working with the jurisdictions to understand what we can build, what we can't build, what do they allow, what code changes are coming down the path, as well as like utilities, right? We've had to work with many different jurisdictions and utility companies to negotiate what we can have. Do we have enough to develop, and is it sustainable? And sometimes when you are developing yourself and you're putting up these projections, what we've learned, right, is that lenders will want And you can do a combination of lending on your property as well as equity. And that's typically what we do, especially when you get into larger projects. And appraisals are good, except for your lender will be the one who wants to order their own appraisal. You can't go set one up and then have it used by all of your lenders. Each lender will want to order one themselves. Depending on the market, can take 2 to 3 weeks. And so what we found is that if you need a quick hit, you can do a CMA BPO. So a CMA is a comparative market analysis, and a BPO is a broker's price opinion on that analysis that says, this, and you want it to be from a third party evaluating the value of your property and what creates that value in that specific area. And when you're dealing with savvy lenders and savvy investors, they want to know that information as well. So having multiple exit strategies or long-term benefits will also hedge your risk. So for example, like when we're looking at residential, we'll say, okay, can we wholesale this? Can we flip it? Can we keep it as a buy and hold? No different in commercial, right? Can I have multiple exit strategies? An example one we do on our RV park is that we are slotting so many RV spots and cabins, but we may take some of the RV slots and then have them where the electricity allows that you can do an RV or a park model cabin. And then that way you can flex, right? If you've got people who want daily and they have their own RVs, right, you can have those slots. If you've got people who want more longer term stays, don't have as many housing options, you can put in a park model cabin, and you can flex as the market needs between shorter term, longer term stays. And then long-term benefits, right? Is it an investment that can improve over time? One example of our first RV park, it's in a city in between two growing cities, especially one that's really growing. But that city itself that our RV park is in doesn't have city sewer. So we had to put in a septic system. However, when the city sewer does come through, we could convert the RV park into a multifamily. So it can have longer term benefits as well, and not just be fixed. And so these are some ways where you can really hedge your risks as well. And you really want to do that analysis. And if you're a passive investor, or even debt, right? You want to make sure that these things have been assessed and evaluated for you to reduce your risks too. So getting started in real estate investing, right? You want to set clear goals. Set clear goals, right? Determine what do you want to achieve with your investment. Do you want to invest actively or passively? Some passive investors want to set it and forget it and grow over time. Some passive investors want to turn their money as quickly as possible, right? They're considered passive because they're not actively working on the property itself, but they're actively working on their money, right? So some people don't want to chase their money all the time, but some investors, even if they're debt investors, right, they want to have one and then they want to turn it as quickly as possible, get that those points and that interest, and then go after another one, which means you're actively working your money. And of course, you can have a higher return, but there are maybe down times where you have your money not working, and you have to go work it. So, you really have to think, is 10% annually good versus 15%? If you have a month or two of gaps in the year, what kind of return would you get? And so you can run the analysis on that. Are you looking for a higher reward with higher risk, or a lower reward with lower risk? And you could also diversify your portfolio with a combination of both, right? High risk, high reward, low risk, low reward. And then another factor to consider is, over what time period do you want your return? Are you looking to make your money quickly? Are you young and you've got a long time before you retire, right? So those things will help identify your investment goals. And then conducting market research, understanding the market conditions, right? So at a macro level, how is the economy, right? How do national policies impact your investments? And so, for example, if you're in the oil and gas industry, each administration has a huge impact on that industry, whether we're drilling or not drilling, right? And it can really impact it at a macro level. How's the unemployment rate? And then even macro, I would say, when you get to national to states, Where are people moving? Where are they migrating to? Where are they migrating from? Why are they migrating? Especially businesses, right? Are businesses moving to or from your area? Whatever the policies are from that state will have a big impact on jobs. And wherever you have jobs, then you need housing, right? And so that really impacts the real estate world. So micro is working with local experts who know the current market and what's coming. So future developments, jobs, jurisdictions, local supply and demand, et cetera. So for example, in the RV park that the other RV park that we're developing right now, we're paying attention to what land is around us right now, but are there companies coming that are buying land behind us down the road? Paying attention to the city chamber of commerce and finding out who's submitting for permits, what's the local supply and demand in that area, and then thinking through what's the ripple effect. So here I've got the core city, and as I expand, which way is that expansion going to go? And so maybe I can invest in something down the road, and then as that grows, I can grow with it. Building a team of professionals, right? So real estate agents, attorneys, accountants, property managers, bankers, lenders, contractors, inspectors. And so remember we talked about the appraisal and the BPO earlier, broker's price opinion, so that you can do the analysis and really get your feasibility. You can hire engineering firms who can help you with your feasibility as well. And then securing finance, exploring mortgage options, private lenders, or other funding. So if you are a developer or operator or an active investor, right, you're going to want to secure financing. And I will tell you that not all banks are created equal. Not all lenders are created equal. They have different interests. They have different risk tolerances. And so you're going to need to find one that matches you. For the first, when we developed our very first RV park, we had to find lenders who were interested in RV parks, and even of those, some of them wanted like the Yogi Berra, water park, theme park type RV park experience, and others wanted just like man camps where there's like no amenities at all. And so you need to find one that matches your project as well. And then if you're looking to invest, how can you invest? Sometimes we don't even realize that we've got ways that we can invest. And so I'm just going to go through a few of them here so you can start thinking, okay, maybe I can be an active investor. Well, maybe I can also be a passive investor and leveraging your portfolio. And so one obviously is cash on hand. Do you have cash on hand that you can invest? A HELOC, so a home equity line of credit. Most lenders will lend up to 80% of the value of your home, and they'll typically go straight off of the county value. For example, when we were in a hot sellers market, the county appraisal wasn't keeping up with the value of the home, and so we requested an appraisal. And so it's a line of credit, so kind of like a credit card. So you only pay for it when you're using it. And so if you can get and the idea here is that if you can get a HELOC line of credit with your bank for, and it usually goes into second position for say 6%, but you can loan out your money at 12%. You can make the money in the spread, loan it out, pay interest as you're lending it, and then when it comes back, you pay it down, and now you've gained that investment in between. Retirement accounts, especially self-directed accounts like an IRA, ESA, HSA, Solo K, Roth IRA. And if you don't know these, maybe what we'll do is bring in a guest speaker who can specialize in each of these as well and talk through them. So you can roll over a 401k to a self-directed when you change jobs, or it's vested because then you can make it into a self-directed retirement account. And then of course you can do a 1031 exchange from one investment to another. So in summary, real estate investing offers income and appreciation. Important to understand key terms and concepts, different types of real estate investments, benefits and risks involved, and steps to getting started. So are you looking for deals to invest in right now? We have deals that might be a fit for you, so connect with us, right? My name is Linda Peterson, and here's my email address, linda@homesforthewind.com, and my phone number, my husband, Andrew Brown, andrew@homesforthewind.com, and his phone number. We will be sending out weekly newsletters to recap these webinars and share deals. To get added to our newsletter, you can go to our website and just opt in, REIFTW, which stands for Real Estate Investing for the Win.com. And then we will also be hosting a weekly Tuesday call at 5 p.m. Central to share info on the deal. So if you're in the newsletters, you'll get the invites for this weekly webinar as well as the deal webinar, and then as well as a recap and other wonderful information too. So make sure that you come back next week. We're going to be covering residential versus commercial real estate, the pros and cons of both, comparative analysis of residential and commercial real estate, highlighting the benefits and challenges of each investment type. So thank you for joining us. We're excited to have you. And as I mentioned before, in our series, we're going to dive into different niches of real estate investing, such as mobile home parks, short-term rentals. We're also going to do storage. We're going to do multifamily. I'll probably invite some attorneys to talk about syndications, some retirement experts. So, go ahead and chime in and tell us and give us some feedback. What niches are you looking for that we can bring in, and we'll learn with you side by side and share our expertise, but also gain some expertise from others in the industry. So thank you for joining. Happy you could be with us, and I hope that you have a blessed day. Take care and have a great day. Bye.